Your superannuation might feel like it is protected by the government, but the truth is that it is a multi-layered tax system hitting your money at every stage of its life. If you want to maximize your retirement wealth, you need to understand exactly how the ATO takes a cut from your account. The very first hit happens the second your money enters your fund. The contributions tax takes a flat 15% off the top of all concessional contributions. This includes your employer's mandatory 12% super guarantee, any salary sacrifice arrangements you have set up, and personal contributions you claim as a tax deduction. If you are a lower income earner making under $37,000, the government offers a rebate called the Low Income Super Tax Offset to refund up to $500 of this back into your account. So it is always worth checking your annual statements to ensure you are getting it. The second tax catches higher earners off guard. Known as the Division 293 tax, it triggers if your combined income and concessional contributions exceed $250,000 in a financial year. When you cross this line, the ATO slaps an extra 15% tax on those contributions, bringing your effective tax rate up to 30%. Next up are the penalties for exceeding contribution caps. While non-concessional contributions, money you have already paid income tax on, normally enter your super tax-free, they are strictly limited to $130,000 per year as of July 2026. If you breach this limit without using the 3-year bring forward rule correctly, you face an incredibly harsh penalty tax of up to 47% on the excess amounts. Once your money is safely inside the fund, it faces the earnings tax. While your account is accumulating growth, all investment income, including interest, dividends, rent, and capital gains, is taxed at 15%. Capital gains on assets held longer than 12 months do receive a discount, dropping the effective rate to roughly 10%. For those who build substantial wealth, a relatively new hurdle exists from July 2026 called the Division 296 tax. This introduces an additional 15% tax on earnings tied to the portion of your super balance above $3 million, raising the total rate to 30%. There's even a second tier where balances above $10 million face an extra 25% tax, pushing the rate to 40%. If you try to access your money too early, before reaching your preservation age of 60, you'll be hit with early release taxes. Even under approved conditions like severe financial hardship, your withdrawals are generally taxed between 17 and 22% once the Medicare levy is factored in. Furthermore, if you transition to retirement while still working, the earnings on those transition assets keep incurring the standard 15% tax rather than moving into a tax-free retirement phase. The final tax is one most people completely fail to plan for because it only triggers after you pass away. The death benefits tax applies when your super is paid out to non-tax dependents, such as adult children. They can be taxed 17% on the taxable component, and if there's an untaxed element, that rate jumps to 31.5%. Managing these layers takes planning, but understanding them early is the ultimate key to keeping your retirement wealth intact.